In last week's video, we outlined some possible bounce scenarios for the S&P 500. That's just what we saw in the prior week. Risk On made a comeback this week. We'll show exactly what changed. We understand that conditions are extended, and we'll look at the stock market crash in 1987 and the flash crash in 2010. From a probabilistic standpoint, the answer to this question is no. When we review the charts, I think you'll agree. Could we move towards that scenario? Absolutely we could, but it doesn't appear that it is imminent or days away. We'll cover some before and after charts, where we reduced risk with our models and booked profits, and why we're adding some risk back in now in an incremental manner. A fair question might be, why did CCM flip from a neutral/concern stance back to a bullish stance? Answer: it was the markets, charts, ratios, and our models that flipped back to a risk-on profile. We didn't do anything except monitor the markets and pay attention to our models. Another fair question: your models have identified a change in risk appetite, but what about? Answer: our models are worthless to us if we don't follow them when they give us signals. Are there things to be worried about? Absolutely, positively, yes, there are. In fact, there are always things to be worried about when it comes to investing. There is never a perfect time in the markets. There's always some geopolitical risk, something hanging over the market's head in the present and in the future. What you can't do when you follow a disciplined approach is rationalize away your signals and decide which ones to take and which ones to ignore. The whole purpose of building the models is to make sure that you don't make the same mistakes that you've made in the past and that people commonly make in the present. What happens if risk off returns in the coming week? Short answer to that is, if we move back to risk off, and we will cover scenarios that show that that's where we could be headed, be flexible, and the models will tell us to realign ourselves, and we'll do that. There's nothing that says we can't get a whipsaw here. In fact, we took an incremental step back towards risk. Why do you take an incremental step? We're acknowledging that a whipsaw or return to risk off could occur next week, and we're acknowledging that there still are things to be concerned about. If the market responds to the probabilities in terms of the improvement, we're happy to take another incremental step towards risk again. If we move to risk off, we're happy to take an incremental step away if that's the right thing to do. The vast majority of this video will try to answer this question: what changed last week? We'll use the NASDAQ as an example, although we could use almost any major U.S. index of price and trends. What changed? What did it look like? What does it look like now? Our models in terms of risk on versus risk off, what did they look like a week ago and what do they look like now? We've been saying for weeks now that we've been looking for a favorable entry point in investment somewhere. We've had trouble finding that, which tells us something. This week we were able to find something that has an attractive probabilistic setup. That too tells us something. We'll look at DeMark a little bit more specifically on the next slide, but a week ago, all three of these bullets seem to align with extended DeMark counts. That's not the case as of the close last Friday. These could come back in line with the DeMark counts next week. Our rule of thumb is if price trends, intermarket trends, our models, opportunities align with DeMark as they did a week ago, then we have a tendency to focus on those signals. When they don't align, we're a little bit more skeptical. What about your risk-reward tables, Chris, that you've been going over? We did see our models in terms of the scores drop from high levels, and they're now moving back up. We're still concerned about risk-reward looking out further, although some pressure has been relieved. Sentiment. From a sentiment perspective, there's no question. The reason why this is an orange, nothing really changed in terms of sentiment last week, so it really doesn't answer that question. But just to give you an update on it, sentimenttrader.com, which is a service that we subscribe to, they have sentiment risk factors on a scale of 1 to 10, both short-term and long-term. Both of those, big picture-wise on sentiment, are at a 5 or a moderate risk level. So in terms of their expertise, they're not seeing the current environment overall. That doesn't mean some things aren't concerning. We're at a moderate risk level. We already talked about what may have changed a little bit relative to the mark counts. Won't want to spend a lot of time on this. Friday's close was 1551.18 in the S&P 500. Your risk levels for DeMark counts on various time frames from 60 minutes all the way out to a monthly chart on the S&P 500. We closed above this risk level, this one, this one, this one, and this one last week. The only one that we haven't breached on a closing basis is this one, and it's a monthly risk level, so it's important all the way out to the end of the month. Further out, if it holds, is 1552.46. The point is, all of these levels, none of them have been violated in such a way that they have invalidated the counts. However, from a probabilistic standpoint, there's a higher probability of a reversal when you never breach these levels. You can see that we've breached quite a few of them. We still respect these counts, but again, from a probability standpoint, a little bit of damage has been done here. To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. Since those of us that know the markets well know the present market here on the right is extended, and therefore we must really understand what a correction and or mini crash or crash looks like. Present day is on the right. This is the flash crash here where I'm moving the cursor in 2010. Point of the exercise. Recently, here, this looks a lot like this. It had many flash crash type warnings, and if you're a CCM client, this look here is one of the reasons why we were very, very defensive recently. There have been and there continue to be reasons to be concerned. However, the market pulled itself back up and we made a new high last Friday. So if we want to look at the risk now relative to the flash crash over here in 2010, the point is, markets don't go typically from making a new high as we did Friday with this type of candlestick, which is a bullish candlestick, to having something like the flash crash. You can see here, here's the high here where I'm moving the cursor. This candlestick here looks similar to last Friday's close. There were 8 trading days of warning and deterioration before the flash crash. If we want to look at indicators, and I could look at them all, but let's just look at one. Let's look at MACD. Here's MACD before the flash crash. Notice our recent MACD looks a lot like pre-flash crash MACD. Again, if you're a CCM client, these looks are one of the reasons why we were very, very defensive in here. In fact, when we had this plunge right here, we had a massive cash position, and for good reason. Again, this looks a lot like this, and this looks a lot like this area in here. Warning signs. Here, you get a bearish MACD cross in 2010. Sometime, I believe this is April 16th, and I believe the flash crash occurs on May 6th. So you had lots of deterioration. This is May 16th The crash occurs on May 6th. This is 3 weeks of ugly charts. We had ugly charts here, and if you're a client, you know we got defensive. So going forward, this could be the high. We just have to do the same thing again. If the market weakens again, then we'll have to get defensive again. The point here, though, is we're probably not a day away from a flash crash type event. It takes time. Look at the MACD here going into the flash crash. We just got a bullish MACD cross last week. So a lot of these similar looks in here and with price have basically been erased or alleviated. This is a bullish cross that we have in place. We'll continue to go forward with an open mind, but this market looks decent here and we should have time to adjust. This is December 31st of 1987. If you're a money manager, it always pays to study crashes and poor periods. You want to be able to look at the present day chart and pretty much innately recognize things that look similar. Here our point is, this is the 1987 crash here that occurred in October. The market made its highest high prior to the crash in late August of that year. It took a long time for the market to deteriorate to a point where it crashed. If the analogy were to hold here, here's your high. We just made a new high last Friday. It's unlikely that we move from this chart here and a new high to either a 2010 flash crash event or something worse in the 1987 order. Do we believe that a flash crash type event or a 1987 event could happen later in 2013? Absolutely, positively, yes. We do believe that if these markets continue to go up in this manner, we have to be vigilant and keep our eye out as we were here recently. If you're a client, you know we're willing to get defensive, and we'll get defensive again if we have to. Just want to point something out here relatively quickly. Don't want to spend too much time on this, but I'm pointing this out to CCM clients. Let's talk risk reward and let's talk stealth correction that somewhat took place. This is the emerging markets index on the left here as of the close on January 23rd, 2013. If you're a CCM client, you know that on January 23rd and 24th, those are the days that we basically took profits, locked them down, didn't like the way these charts looked. A lot of people may say that's not a good move because the S&P 500 moved up. A lot of things did not move up in that area. There were stealth corrections taking place in Europe, in material stocks, anything that was somewhat cyclical related or commodity related, emerging market related, did not do well. So let's look and see, risk reward wise, how we did by not participating between January 23rd and the close over here on March 8th. Let's talk about the most important thing, buy low, sell high. January 23rd, the EEM ETF closed right here where the cursor is at 44.47. We basically were out here. Here's EEM in the present day. This candlestick right here is the day we got out, basically. Here it is right here. What happened after that? Well, what happened after that was a gut-wrenching, poor risk-reward period where EEM had a little mini tank in here while we were sitting safely in cash and sleeping well. Now, most important thing, close here, 44.47. We bought it back, even though we didn't own it before, at a lower level. You want to try to sell high over here and buy back at a lower level. And I'm really not even concerned about buying back at a lower level. I'm more concerned about exiting a position that has a poor risk-reward ratio and entering a position that has a better risk-reward ratio. So from this point here to this point here, we diligently looked for good risk-reward opportunities in here. We just didn't find anything that we were happy with until Friday. Now, this candlestick looks a little hesitant. There's a breakout here. We know we could be wrong on this buy on EEM, but the setup is there, and we've been waiting for a setup to come. And let's look at risk-reward just on the indicators that are here on the screen. The day we sold, look at RSI. That looks very, very concerning. Let's look at RSI the day we bought, which was Friday. RSI came down near oversold territory and has now recaptured the 50 level. That's a good sign. When we sold out, that's a disturbing looking MACD. That's a bearish cross, doesn't look good. It corrected, and now when we're getting back in, this MACD entry point is infinitely better than this MACD entry point from a risk-reward perspective. Full stochastic, the day we got out, bearish cross approaching 50, didn't look good. It got worse after we got out. Now, came down, consolidated, was near oversold territory, went into it here, and now we're back above 50. This risk-reward point here is much, much better than this one here. Let's look at on-balance volume. Sideways action, not particularly bullish or bearish here. Not really a reason to sell, but let's look at it now. You can draw trend lines here. On-balance volume broke out above this resistance level here and somewhat confirms this. So from a price perspective, sold at a higher level, bought back at a lower level. Models worked extremely well. From a risk-reward perspective, sold out of a poor risk-reward environment, bought back in at a lower level at a better risk-reward entry point. Earlier in this video, we noted that the most efficient and effective way, really the easiest way to monitor markets, is to monitor price, and that's what a true trend follower does. Here we'll step through how the markets deteriorated and how they look now and why we became defensive and now we're willing to take some risk again. Things deteriorated and then they improved. You can see here this chart where I'm moving the cursor is as of February 25th. Why is this concerning? A lot of things technically, intermarket, DeMark-wise, sentiment-wise to be concerned about in this area. Price starts to confirm that by making a lower low here. This low is lower than this low here. And typically what you'll find, and we showed this chart, I believe, on short takes, we at least tweeted it, typically what you'll find in a new downtrend is that this parallel trend channel will hold. So our game plan was, let's see what happens from here. Are we going to break this way? Or are we going to go up to this trend channel and bounce back down? Or will we break out? So let's skip forward here and see what happened and walk through it. Now we're looking at 2 trading days later, or February 27th up here in the left-hand corner. We bounced here and started moving up. If you're an investor here, as we are, we don't know what's going to happen here. This looks potentially like a downtrend, and until we see what happens here, and more importantly, if we can get into this region here and hold it, it's prudent to have some skepticism. What you're basically saying is, why would I buy here when I believe that 2 or 3 days later I may bounce this way and come back down? Part of your risk management is to make the market prove to you that it can do something convincingly bullish in this area. Quick look here. This is Friday, March 1st. Nothing here says that this trend channel has been violated yet. Patience for investors. Traders play this differently than we do. Their time horizon is different. If they were to buy here, that's prudent for their time horizon. For us, it's prudent to see what happens here in terms of managing risk versus reward. Now we've moved one day ahead. This is Monday, March 4th, 2013, here in the upper left-hand corner. Bullish developments from where we sit. Why would I buy right here when I might hit this trend line and bounce back down? Patience was in order. Let's see what happens. If we don't keep an open mind about what will happen here, we may not be prepared. Inexperienced traders or investors might assume that this will hold. The longer you do this, the more you realize you shouldn't assume anything. What we should do is pay attention with an open mind and just see what happens in this area. And you can see that is a bullish breakout. One good thing about the breakout too, we closed near the high of the session. On our time horizon, a couple of things can happen. Typically, we like to look at the worst case scenario and always be thinking about risk management. This chart is Tuesday, March 5th. Since this breakout occurred on a Tuesday, and a lot of our market models, the CCM Market Risk Model, the CCM 80-20 Correction Index, and the CCM Bull Market Sustainability Index, affectionately known as the BMSI, use a lot of weekly charts. From our perspective, another piece of due diligence to err on the side of making the market prove it to us, we can wait till Friday. We can wait through Wednesday and Thursday until the close Friday to see if the improvement that we've seen at this point on the weekly charts, and we had seen improvement at this point. Things look bullish here, and that's why we were ready to move on Friday if we saw what we wanted to see. But sometimes intra-week, you can get head fakes on intra-week charts. They may look bullish on Tuesday or Wednesday, and then on Friday they might flip back to the bearish case. It's also not unusual to have a breakout like this and then have it immediately fail. So you like to see what happens here and make the market prove to you that it can hold above this trend line. We still may see a retest of this trend line going forward. Not unusual at all to come back and retest a breakout. The last look here shows us how the chart closed out the week, did everything we wanted it to do. It broke above the downward sloping and potentially bearish trend channel. It held the breakout in a very favorable manner and finished near the high for the week. Very, very difficult to look at this chart from a price or a trend perspective and say that it's a negative chart. Again, want to emphasize we could come back down and retest this trend line next week. What happens here is important, and this might actually be a good place to redeploy more cash if we get a pullback here and bounce. As you might imagine, it takes a lot of time and effort to produce these videos. Our thought process is that if you try to help others, typically good things happen. We're trying to help you here. If you find this video helpful, how you can help us is to retweet a link to it or cut and paste a link to it into a blog or an email. That's very, very, very much appreciated, and all the followers are appreciated, all the readers and all the viewers of these videos. Now we're shifting gears. We showed how to use price to determine what the trend is, why we were nervous, why we're not as nervous now. Now we'll flip over to risk on versus risk off charts. This is a chart, a variation of it. We use a similar chart in the CCM market risk model. This is a weekly chart. We went over this in excruciating detail last week. So if you Google Shavako Capital channel, find the video with this title, and in it we describe this chart, again, in excruciating detail. S&P 500 divided by the VIX. This is risk on versus risk off. This is what risk on looks like. This is the S&P 500. This is what risk off looks like. This is the S&P 500. Point of the exercise. This is the chart that we went over last week as of March 1st, 2013. Covered these concerns. This is what a top looks like in the S&P 500. This is what a top looks like. The top occurred near the top of this trend channel. Top occurred near the top of this trend channel. Well, we just rolled over in a similar manner that looks very, very toppy here. MACD as an indicator. Rolls over, bearish cross. On Friday, March 1st, this looks a lot like the topping process in the S&P 500, here and here. We could make the same case for these other indicators down here. What we'll do now is we'll go split screen, and let's compare the look on March 1st of concerning looks to the look that we have now. And before we move there, if you view last week's video, we noted that the bounce scenario this week needed a gap up on this chart. You can see right here, gap up, S&P 500 bottoms. That's what a bottom looks like here. Here on this chart, this is a gap up, S&P 500 bottoms. On this chart here, we get a gap up, S&P 500 bottoms. So on the March 1st video, we said we might get a gap up because those gap ups occurred here. That's a gap up. Follow the line up. Gap up occurred here. Line up, gap up occurred here. Same line, gap up occurred. The pattern said that we might gap up the following week, which was last week now. Let's look and see what actually happened. I think we also noted in last week's video that the gap up scenario, and this is the chart still here as of March 1st, this is as of the close last Friday. We said the gap up scenario was one reason why, even though we were concerned and risk averse and even bearish, that we weren't willing to go to the short side of the market or even buy bonds here because the bounce bullish scenario for stocks had not been taken off the table. So we said we needed a gap open here. What do we get? Here it is. We got it. Gap open. Huge gap. Looks like this gap here. Now, after these gaps, the market had a tendency to go up for several weeks. However, we had a shorter term pullback in the S&P 500 than we would have expected from this high here to this low. And that's because we have this somewhat of a triangular formation. We're going more narrow. What does that tell us? It tells us that if the pullback that we just expected to have happen really didn't happen because we have a rising trend line here, it also tells us that this resistance could come into play. And this resistance here, this is the S&P 500, this is topping resistance. So this chart is telling us that even though this is bullish and we reestablish some long positions, the market still has some work to do. We need to see this chart move into this area here. As long as it congregates in this area here or this area here, this is the S&P 500, you still look toppy. But there's no question this is bullish. And let's look at the improvement in the indicators. This is the S&P 500 here. This is when we were concerned. Well, this week, look at that. That doesn't look too bearish. Here's MACD when we were concerned. It has the rollover look. Well, look at MACD now. It did what we call a kiss. The black kissed the red. That happened here. You can see there's somewhat of a kiss. We came down, somewhat of a head fake look, and the S&P 500 took another leg up. You're just going to have to trust me on these, what they are. The first one here is RSI. RSI, when we're concerned, is down at 50. Probably mentioned, or at least we knew or noticed, that you can get a bounce at 50. Here's a bounce at 50. A bounce at 50. Not really interested in shorting here yet or even buying bonds yet until we see what happens. Well, as it turns out, March 1st, this is last Friday's close, it did bounce in a bullish manner. PPO, Concerning look. Here it bounced. If we look at this here, I believe that's Williams percent R. It is. That's Williams percent R. This orange line here and this orange line is what a previous top in the S&P 500 looks like. Williams percent R, overbought, comes out of overbought territory. Williams percent R, overbought, comes out of overbought territory. Friday, March 1st, overbought, came out of overbought territory. This looks concerning, and from a risk management standpoint, if you don't take action based upon our time frames and expertise, then you're not doing your job. This is a concerning look. Well, look at it. Look what happened. This is the before here. This is the after. This is as of last Friday's close. This is concerning. This is not concerning. Now we're up back in overbought territory. So until we move back in this direction, and we may be right back down here next week. We have to be prepared for that. Markets can give what's known as a whipsaw. We could get a whipsaw scenario. Here, we've got the Copic curve. Our concern on March 1st was that the Copic curve was rolling over. This is what a top looks like, the orange line. This is where the S&P 500 peaks. Rolling over, this is what a top looks like. Rolling over, this is what a top looks like. Well, we didn't roll over. We're moving up. That looks bullish, so we're not going to ignore that. If we scroll down a little bit further, compare concerning looks to present day looks, this is CCI. This is what a peak in the S&P 500 looks like. Overbought, out of overbought territory on a closing basis. Overbought, out of overbought territory on a closing basis. When I say on a closing basis, this is what the chart looks like on a Friday, on a weekly close, not intra-week. This close on March 1st looks similar to this peak and this peak. Well, what happened the following week? We bounced right here, and we're back up into overbought territory, which is different than this bounce here. This bounce never made it back above the 100 line. This one did. We closed above it. That tends to be a good sign. Here, this is TSI. A peak, you get this rollover look, black moving towards red. This is where the S&P 500 peaks. A peak in the S&P 500, black rolling over towards red. Last week, this is March 1st, Friday, March 1st, so actually 2 weeks ago now. This looks concerning. We kissed it, came off of it. So that doesn't look nearly as concerning as this does. This is moving up now. Keep an open mind. All of this could reverse next week. ADX. Green was falling on March 1st. You can see here's a peak in the S&P 500. Green falling. Peak in the S&P 500. Green starts to fall. March 1st, green falling. This looks concerning. Well, it also kissed. Green up. Close last Friday looks a lot better than the close on March 1st. Rate of change, similar situation. S&P 500 peak, indicator for risk on, risk off. Rate of change is falling and approaching zero. It's a bearish look for stocks. Here, S&P 500 peak at the orange. Rate of change falling, heading towards zero, bearish for stocks. Friday, March 1st, rate of change falling, moving towards zero, concerning. Hence why we had a large cash position. This is a toppy look. This is a toppy look. This is a toppy look. This week, we erased the toppy look. It's not a toppy look as of the close last Friday. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.